Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the Risk Spotlight portal, the premier forward-looking service for operational risk content. Let's get started. To begin, a recent report from Security Scorecard revealed that all of Europe's largest financial institutions experienced third- and fourth-party data breaches in the past year. With the EU's Digital Operational Resilience Act, DORA, taking effect in January 2025, organizations must strengthen supply chain risk management. Scandinavian firms were identified as the most secure, whereas French firms lagged with the highest incidence of vendor-related breaches. These findings highlight the growing complexity of supply chain vulnerabilities and the necessity for organizations to implement robust third-party risk management frameworks. This involves not only compliance with DORA, but also fostering collaboration among internal and external stakeholders to identify and mitigate risks proactively. Moving on, the sharp rise in phishing attacks has been another pressing concern. According to SlashNext's 2024 Phishing Intelligence Report, there was a 703% surge in credential phishing attacks in the latter half of the year, with mobile threats and multi-channel approaches becoming more prevalent. Attackers have become increasingly sophisticated, leveraging collaboration tools like Microsoft Teams and Dropbox, which further emphasizes the importance of deploying real-time threat detection and prevention tools. Additionally, training employees to identify phishing attempts and encouraging secure communication practices remain key defenses against these persistent threats. Organizations are also urged to adopt advanced authentication mechanisms, such as biometric or device-based authentication, to stay ahead of evolving tactics. Shifting focus to the United States, the Securities and Exchange Commission, SEC, had an active fiscal year 2024, particularly in the areas of cybersecurity disclosures and AI-related misrepresentations. Notable enforcement actions included cases against firms overstating their use of AI, such as claims of delivering above-market returns or being the first regulated AI financial advisor. These actions serve as a reminder for organizations to ensure transparency and accuracy in their public statements, as misrepresentation not only invites regulatory scrutiny, but also risks reputational damage. The SEC's cybersecurity enforcement efforts were equally vigorous, with the case against SolarWinds serving as a critical example of the challenges in determining materiality in cyber incident disclosures. Despite some claims being dismissed, others, including misrepresentation of cybersecurity practices, were upheld. These efforts underscore the increasing regulatory focus on transparency and compliance, urging organizations to maintain comprehensive cyber risk management programs. In related developments, the Financial Stability Institute of the Bank for International Settlements released a policy implementation insights paper exploring AI's impact on financial services. The report addressed both existing and emerging risks, such as data privacy and hallucinations in generative AI, and emphasized the need for global regulatory harmonization. Particular attention was given to governance, third-party AI providers, and new business models. Financial institutions are encouraged to adapt to these insights by strengthening AI governance structures, integrating risk assessments into development cycles, and ensuring a thorough understanding of the AI supply chain to enhance operational resilience. Meanwhile, India's cybersecurity landscape is facing unprecedented challenges, with nearly 1.2 billion attacks reported in Q3 2024 alone. Indusface highlighted the banking and utilities sectors as primary targets, attributing this to geopolitical tensions and the increasing use of AI tools by attackers. Regulatory bodies like the Reserve Bank of India are urging organizations to prioritize rapid incident response and systemic vulnerability mitigation. These attacks also underline the need for Indian organizations to invest in threat intelligence capabilities and foster partnerships with cybersecurity experts to better navigate the evolving threat landscape. On another front, the rise in API attacks was highlighted by Wallarm's research, which found that newly deployed APIs are discovered and targeted by attackers within 29 seconds. These exploits often use common ports and protocols to infiltrate systems, making robust API security essential for modern applications. Organizations must not only adopt security measures at the development stage, but also continuously monitor API environments to detect and address vulnerabilities promptly. Advanced endpoint protection and network segmentation are recommended to prevent attackers from gaining lateral movement within systems. Turning to corporate governance, the use of AI-powered note-taking tools has sparked concerns over confidentiality and privilege. While these tools can enhance efficiency, they pose risks such as data breaches and the inadvertent loss of privileged communications. Boards are advised to implement stringent policies and conduct thorough vendor assessments to safeguard sensitive discussions. Additionally, creating protocols for reviewing AI-generated notes and limiting their distribution can further mitigate risks. Finally, the Department of Justice's corporate enforcement efforts have been bolstered by a new whistleblower reward program. This initiative has already led to a surge in voluntary self-disclosures and opened avenues for tackling corporate misconduct. Companies are encouraged to strengthen their compliance frameworks and ensure whistleblower policies are effectively communicated to employees. Enhanced employee training on ethical practices and the provision of anonymous reporting channels can further support organizational integrity. Lastly, data breach class actions have emerged as the fastest-growing litigation segment, driven by high-profile cases like Marriott's $52 million penalty in 2024. A Capitology study revealed that data breaches often result in significant stock price declines, with financial institutions experiencing the steepest losses. Preventative measures, including robust cybersecurity frameworks and proactive breach management, are critical to mitigating these risks. Engaging external cybersecurity consultants and adopting comprehensive breach response plans can significantly enhance organizational preparedness. Now let's turn to key operational risk loss events reported last week. The first update is about the recent ban imposed by the UK Advertising Standards Authority, ASA, on a Lloyds Bank advertisement due to misleading claims regarding its environmental impact. The ASA found that the ad, which highlighted the bank's efforts to support a low-carbon economy, failed to disclose significant ongoing financing of fossil fuel projects, which contributed to greenhouse gas emissions totaling approximately 32.8 million tons of CO2 equivalent in 2022. This ruling followed a complaint from the activist group Ad-Free Cities, emphasizing that consumers were likely misled by the omission of critical information that would have contextualized Lloyd's claims about its sustainability efforts. The next update is about a major theft incident at Japan's MUFG Bank, where a former employee allegedly stole over 1 billion yen, $6.5 million, from customers' safe deposit boxes. MUFG Bank's CEO has publicly apologized for the incident, which has shaken trust in one of Japan's largest financial institutions. In response to this serious breach, the bank has vowed to strengthen its compliance measures and improve security protocols to prevent similar incidents from occurring in the future. The next update is about a landmark legal action taken by Australia's corporate regulator against HSBC's Australian arm for allegedly failing to protect customers from a sophisticated scam. The Australian Securities and Investments Commission, ASIC, has filed a lawsuit in the federal court, claiming that HSBC Australia's inadequate fraud prevention measures led to 950 customers losing approximately $23 million to scammers between January 2020 and August 2024. ASIC alleges that HSBC was aware of the risks but failed to address gaps in their fraud controls, resulting in some customers losing over $90,000 each and facing significant delays in fraud investigations and account access restoration. The next update is about a significant data breach at SRP Federal Credit Union, a major financial institution based in South Carolina. Between September 5th and November 4th, 2024, cybercriminals infiltrated SRP's computer systems, potentially accessing and exfiltrating sensitive information of over 240,000 members. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, Stay safe and keep those risks in check.